Let's talk about the RSI, the Relative Strength Index. It's a tool you see on pretty much every trader's chart, right? But here's the thing. A lot of people misuse it. They treat it like a simple buy or sell button, and honestly, that's why it so often leads to losses. In this explainer, we're going to break down a completely different way to look at it, an approach that's all about structure and patience, not just trying to predict the future.
And really, that's the whole issue right there. The problem isn't the indicator itself, it's how we're taught to use it. My goal here isn't to give you some kind of magic formula, but to help you completely rethink this tool and approach the market with a clear, step-by-step process.
All right, so here's what we're going to cover. First, we'll dive into what the RSI actually does. Then, we'll walk through the specific rules for this reversal strategy. After that, we get to the most important part, managing your risk and your profit. We'll also look at the common traps people fall into, and we'll finish up with the real key to long-term consistency.
Okay, so first things first, to use this tool the right way, you kind of have to unlearn what most people think it does. This is a crucial mindset shift. So many people think the RSI predicts the future. It doesn't. It is not a crystal ball. All the RSI does is measure momentum. Think of it like a speedometer for the market. It just tells you how fast and how far the prices moved recently. That's it.
This is the absolute key takeaway. So really let this sink in. Stop thinking of the RSI as a prediction tool. Instead, think of it as a warning light on your car's dashboard. All it's telling you is that the engine, the market, has been running really hot and fast. It's a signal to pay attention, not a signal to immediately hit the brakes or floor it.
So you might be asking, okay, why focus on the 5-minute chart for this? Well, it's because markets get ahead of themselves all the time on these short time frames. You get these quick, sharp moves because of a news event, the start of a trading session, or something called a stop hunt. And after these big, fast moves, the price often has a little snapback. We're not trying to catch the absolute top or bottom of a trend, we're just aiming to catch that small, probable pullback.
All right, now let's get into the nuts and bolts of the strategy. The whole idea here is to create a mechanical process, something you can repeat without letting your emotions get in the way.
The setup itself is super simple. We're on a 5-minute chart using a standard 14-period RSI, and we're just watching two levels, the 70 level, which we call overbought, and the 30 level, which we call oversold. Okay, listen up, because this is probably the most important rule in this whole breakdown. This is where almost everyone messes up. Just because the RSI hits 70 or 30, we do not automatically enter a trade. That level is simply a condition. It tells us to start paying attention. It is not a trigger to act. If you act on the level alone, you're just guessing. We have to wait for confirmation.
So what does waiting for confirmation actually look like for a buy setup? Well, first, you get that big sell-off, and you see the RSI dip below 30. Now we wait. We do nothing. We watch for the price to slow down, to stall out. The actual trigger to enter is when the RSI crosses back above the 30 line. That's our confirmation, and we enter when that candle closes.
And for a sell setup, you guessed it, it's just the mirror image. The price has a strong rally, and the RSI goes above 70. We don't jump in, we wait. We watch for the momentum to fade. And our trigger is the RSI crossing back below the 70 line. See the difference? Patience is what turns a random guess into a calculated entry.
Okay, so we've got our entry rules. But honestly, you could have the best entry signal in the world, and it would be totally useless without what we're about to talk about next. This is where traders really make or break their careers.
And here it is, the #1 rule of staying in the game. You risk a tiny fraction of your account on any one trade, ideally somewhere between 0.5% and 1%. That's it. This discipline is what keeps you around long enough to be successful.
So where do you put your stop loss? It's simple, really. You place it logically, just beyond the recent peak for a short trade or just below the recent valley for a long one. And please, never set your stop based on the RSI indicator. You always control your dollar risk by adjusting your position size, not by moving your stop closer. This quote just says it all, doesn't it? If you're feeling that knot in your stomach when you set your stop loss, that's a signal. Not from the market, but from yourself. It's telling you your position size is just too big for you to handle emotionally. The answer is simple. Reduce the size until that feeling goes away.
It's so important to be realistic about what we're trying to do here. This is a scalping strategy. We are aiming for small, quick, high-probability moves. We are not trying to catch the absolute top or bottom and ride a new trend for weeks. We're getting in and we're getting out.
So where do we take our profit? Well, you've got a few solid mechanical options. You could aim for a nearby support or resistance level, or you could just target a simple 1-to-1 or 1.5-to-1 risk-to-reward ratio. Another good option is to exit when the RSI makes its way back towards the 50 level, which suggests that momentum has kind of neutralized.
All right, so we've got the rules, we know how to manage our risk. Now let's talk about the traps. These are the classic mistakes that trip up so many traders who try to use the RSI.
You already know the biggest one, right? Jumping in the second the RSI hits 70 or 30 without waiting for any confirmation. Other huge mistakes include using a position size that's way too big, trying to fight a really powerful, obvious trend, and feeling like you have to trade every single signal you see. True discipline is knowing when to sit on your hands and wait for the A-plus setups.
And all of this brings us to a really important point. Long-term consistency in trading, it has very little to do with which indicator you happen to pick. It's all about the principles you trade with.
If you look at why an approach like this actually works, it's not magic. It's really about three things: waiting for confirmation, having ironclad risk control, and understanding basic market structure. And notice which one is the biggest piece of the puzzle? It's risk control. That is your foundation. That's what keeps you in the game.
At the end of the day, trading is a game of probabilities, not certainties. Real success comes from having a structured plan, executing it with discipline, and, above all else, protecting your capital. It's a process of survival, not a game of being right.
So I'll leave you with a question to think about. Take an honest look at your own trading. Is it built on a disciplined, repeatable process? Or is it really driven by an emotional need to guess what's going to happen next? The answer to that question can tell you everything.
Because here's the truth. Real, lasting consistency is never found in a perfect indicator or some secret strategy. It's built slowly, one trade at a time, with discipline, with patience, and with a relentless focus on managing your risk.